Assalamu alaikum students, my name is Fizan Farooq and I am your facilitator for the financial accounting paper. In our today's class, we will discuss the basics of accounting. So, before we move forward, the first thing we need to learn is what is accounting. What is accounting? The subject we are going to start is financial accounting. So, first of all, we must know what is an accounting. So, accounting is a technique where we are summarizing, analyzing the financial transactions. Financial transaction means anything which involves money. Money, dollars, pounds, dirham, any currency units. Anything which we can measure in form of money is part of accounting and it's known as accounting transaction. In this business world, we are purchasing lots of things by using cash. Where the cash is involved, it's a financial transaction, and we will record, summarize, analyze all types of financial transactions in our accounting syllabus. So this is a very simple definition of accounting, that accounting is simple summarizing, analyzing of financial transactions. Now, accounting, we know there are five main elements, five main pillars of accounting, which are very basic and we must know it, otherwise in future it will be a big problem. So very carefully focus and see what we are going to discuss now. The five main pillars of accounting are: number one, assets. What is an asset? First we will discuss about assets, then we will move to the next one. What is an asset? Assets simply the resources of business. Assets are simply the resources of business. Resources yani anything which we own. For example, just look at your surrounding. You will see lots of assets. For example, your computer, your laptop, your mobile, the furniture. If you visit a factory, you will see equipment, plant, machinery, anything which you have, your car, your motor vehicle, van, anything which you own is yours asset. So, asset is simply nothing but resources of business. Anything which business own is an asset. Now, in our normal life, if we just look at our surrounding, as I just said it, that we can see lots of assets. For example, I just told you that the car, the vehicle, the equipment, the machinery, the furniture, yours mobile, yours laptop, your computer, everything which you have it, which you own, it's yours asset. Now, there are two types of assets. Number one, current asset. Number two, non-current assets. How we are going to distinguish between them? It's very simple. Just remember one thing. The types of asset based on the life of an asset. For example, you have a car. Just assume you have a car. If you don't have, inshallah, you will have it after you complete your ACCA. So, inshallah. So, the thing is, if you have a car, the car life of a car is 1 year or more than a year. What do you say? So, definitely, sir, the car usually have a life of more than a year. So, okay. So, the life of a car is more than a year, greater than 1 year. Okay. The flat, if you own your flat or your house, your accommodation where you are living, if you own it, if it is yours, the life of the flat or apartment, sir, it's long term, yani more than a year definitely. Your mobile, your computer, your printer, your machinery, your equipment, all of them usually have a life of greater than or more than a year. So those are classified as non-current asset. Why? Because anything which you own and have a life of more than a year, it's a non-current asset. Simple. So what is current asset? Current asset, on the contrary, on the other side, life up to 1 year. If a life of an asset is up to 1 year, it is known as current asset. Simple. Example, just assume you have cash, money, cash, or you have money in the bank and you are running a business. In the business, nobody is keeping cash for more than a year. Cash is coming in, you are selling goods, you are getting money, you are buying goods, you are paying cash. Money coming in, money going out, money comes in, money goes out. Yani money is nothing but is in circulation. So anything which we circulate during the year, not keeping it more than a year time, it's called current asset. So what we just discussed, I will recap it, that assets, resources of business, anything which you own is your asset. There are two types of asset. One is non-current, another is current. Non-current asset means the life of an asset more than a year time is a non-current asset, and if life of an asset is up to 1 year time, it's a current asset. You must memorize this definition. Why? Because in your accounting profession, assets, you will going to record the assets, you will going to depreciate it, and a long story is going to come. So must clarify all the basic concepts right now, otherwise later on it will make problem for you. So till now we just discussed what is an asset. Now how to deal with assets in accounting we are going to discuss. Simple thing is, we buy asset and we sell asset. Yani we are acquiring asset, we are getting assets, and we are losing them or we are selling them. Asset comes in, asset goes out, asset comes in, asset goes out. Yani in other words, in technical words I can say, increase in asset or decrease in asset. If asset got increased, technically in accounting language it's called debit, and if asset got decreased, it's called a credit. Increase in asset is a debit, while decrease in an asset is going to be credit. Must remember that. Increase in asset is, just repeat it, increase in an asset is a debit, while decrease in an asset is a credit. Okay. What is an asset? Asset is a resources of business. Its increases on which side? Its increases on debit side, while its decreases on credit side. You must memorize that and you must repeat it again and again. Now let's do a example. Our first question, our first example of financial accounting course is at front of you now. Just assume purchase of computer. Let's say purchase of a computer for $100,000. Mashallah, $100,000. It's a supercomputer, yani. We are buying a computer for $100,000 for cash. How to deal with it? First time we are doing it, so be very careful. What is coming in and what is going out? Think in this direction. What we are getting? Sir, we are getting a computer. Why? Because we are buying a computer. It means we are getting a computer, we are having a computer. Okay, you will get a computer. The computer comes in. Okay, what going out? Sir, we are getting computer. Mr. Computer is coming in. And what is going out? Sir, money, fulus, money, cash is going out. Okay, computer comes in, cash goes out. How to deal with it? Be careful. Increase of an asset is called, what is called? Debit. Decrease of an asset is called credit. Computer is an asset. We are getting a computer. So computer comes in. So we will say debit, debit, computer, debit. Computer comes in, so computer is a debit. Why? Because computer is coming in, which is an increase in an asset, and asset increases on debit side. So under the heading of debit, I am writing 100,000. The reason is computer. Why we did this? Because asset increases on debit side. Halas. Any problem? You can ask us again and again, no problem. Then computer comes in, we acquired, we purchase computer. What goes out? Money, cash, fulus. The money goes out. Okay, money goes out, money is going out, which is a increase in cash balance or a decrease in the cash. So definitely, sir, computer comes in and cash goes out, money is going out. We have a decrease in money, decrease in cash. So cash is going out, cash is decreasing. So decrease in an asset is called a credit. So what we will do, under the heading of credit, we will write cash. You will witness that I give a space here. This is the way, this is the method to write an entry. First, on the top, we always write a debit, then we will write a credit, and we keep a small space here. So that is our first accounting entry, which is called double entry, which is also known as double entry. Double entry means we have debits and we do have credits. So in this entry, we bought a computer. So computer comes in, computer debit, and money goes out, cash, credit. So that is our very first transaction. Let's move to the second transaction. The second transaction is going to be like this. Purchase furniture. Let's say $10,000 cash. We bought a furniture for $10,000 cash. Just think. Now you guys think. What's coming in and what is going out? So sir, simple. We are purchasing furniture. So furniture is coming in. Asset increases. The name of this asset is furniture. Furniture is an asset and it's increasing. And we know that asset increases on debit side while it decreases on the credit side. So furniture comes in. Furniture is coming in means furniture is increasing. So on the debit side we will write furniture $10,000. What is going out? Sir, we are getting furniture and we are paying it for cash. So money goes out. Money goes out means cash is going to decrease. Cash is going to be decreased on, yani asset is decreasing on which side? Asset decreases on credit side. Money comes in, money goes out, furniture comes in. Furniture is an asset, asset increases, which is on debit side. Cash is going out, which is again an asset, is on credit side. So this is our second transaction. Let's move to the last transaction for this topic, then we will move to the second element of accounting, which is going to be liabilities. Let's say purchase of land and building. We are rich peoples now. We are buying land and building for $1 million. Wow, $1 million. So what is going to be the entry? Now you guys think by your own. What is coming in and what is going out? So sir, very simple, very easy. We are acquiring, we are buying land and building. So land and building is coming in. land and building is coming in, 1 million is the worth, 1 million is the value, so it's a debit. Why? Because it's an increase in an asset, and increase in an asset is always be on debit side. What is going out? Sir, money, cash. Cash is going out. Cash is again an asset and is going out, yani it's a decrease in an asset, or an asset is going to decrease on credit side. That's it. That's it for the assets, that how to deal with assets. Assets are the resources of business, increases on debit side while they are decreasing on credit side. Simple. And we did 3 illustrations, 3 example questions to know how to deal with the debit and credit, yani the double entry for the assets. Now the second element of accounting we are going to discuss. The second element of accounting is liability or liabilities. What is an liability? Liability is simple obligations. What obligations are those? Let's see. Just assume today you went for a dinner to a restaurant and you finish your dinner, and now it's a time to pay the money. When you check your wallet, you forgot the money at home. Oh, what is going to happen? Simple embarrassment. Okay, embarrassment is okay, but what next? You have to talk to the restaurant guy that, bro, hey mate, I forgot my cash at home. So please allow me some time. Please allow me some time. Let me go back to the home and bring the cash and pay you. Just assume this guy is very good guy and he allows you this, that go home and bring the money. So till the time you will go home, come back and pay him the money, he is allowing you a credit facility. He is allowing you a credit. Allowing you a credit means it's his right to get the money and it's your obligation that you will pay him. Why? Because you already finished the dinner. You already took the services from him, and now you are not paying it right now. You will pay him later on, after half hour, after 10 minutes, or whatever time you are going to take. It's up to you. So simple thing is liability. You have to pay. You have to pay. It's your obligation. And you took a service, you utilize the service. Instead of paying right now, you promised a person that I will pay you later on. So this type of arrangement is simple a liability on your side, that you have to pay. Another example, you don't have money, you want to establish your business. So what you will do? You will go to simple bank, you will go simply to the bank and you will ask bank that, hey bank, I need to borrow some money. Okay, bank will lend you money. But is it yours money? No, it's not yours money. You have to pay back to the bank. Have to pay back. Pay back. Yani again, it's an obligation on you, and technically or in accounting language, this obligation to pay is known as a liability. So liability is nothing but obligation to repay, obligation to pay. Now, just now we discussed asset increases on debit side and decreases on credit side. What about liabilities? Liabilities increases on credit while decreases on debit side. Asset increases on debit, decreases on credit, while the liabilities are going to increase on credit and decreases on debit. You can say it's a completely contrast or completely contrary with the asset. Asset increases on debit while the liabilities increases on credit side. Simple. Asset do have 2 types we just discussed. Liabilities also have 2 types. One is called current liabilities. The second one are non-current liabilities. Same like assets, it depends on the time. If you took a loan from the bank and bank allows you to repay it in more than a year time, and usually it happens that bank loans you will have around 3 years, 5 years time. You took car finance from the bank. Car finance means you took car through banking arrangement. You are not paying it right now, you will pay later on to the bank, and bank bought a car for you. Again it's a loan, again it's a liability. It's a 3 years, 5 years liability. More than a year, just remember you have to pay back in more than a year time. So this type of arrangement or this type of loan or liability is called non-current liability. While if the arrangement is like that if you borrow money from your friend, or just now you went to the restaurant and you forgot your wallet and he allows you to go home and bring the cash, is some minutes, some hours, or some days, yani within a year time. If you have to pay back within a year time, this type of arrangement, this type of liability is known as a current liability. Other than that, if the lender, if a person allows you to pay back in more than a year time, it is known as non-current liability. Simple. Now, just look at this example. Borrow $100,000 from bank. This is a simple transaction at your screen. We are borrowing $100,000 from bank and we need to do debit credit, yani we need to record this transaction, or we need to make a double entry for this. Double entry means debit credit. Just relax, be calm and think what is coming in. First of all, we are borrowing from the bank. We went to the bank, we ask money from the bank that, hey bank, please give me some money, I will pay back. Borrow means yani you are getting a loan. Simple. You are getting a loan is fine. Money is coming in or going out. Think about yourself. You are borrowing. So money is coming in. We are getting the cash. So money, cash, which is an asset, comes in. Asset increases, yani I got the money, I got the cash, I got the money. If I got the cash, I got the money, it's an increase in an asset, and asset increases on debit side. Okay. Anything going out from me? No. I am not giving any of my asset. No, nothing is going out. So what is going to be the second impact? What is going to be a credit? So just think, we are borrowing from the bank. Borrowing means it's your obligation to pay back the money to the bank. Yes or no? Yes, you have to pay back. Yani ultimately your liability is increasing. The money is coming in, okay, asset is increasing. On the other side, the liability is also increasing. Why? Because you have to pay it back to the bank. You have to pay it back to the bank, and your liability is also increasing. And liability increases on which side? Liability, sir, increases, just you write it here, sir, you wrote it here, sir, that liability increases on credit side. So what I will write? I can write loan, I can write payable, any word, yani payable is also okay, loan is also okay, loan payable is also okay, but we must know that it's an increase in liability, that's why it came on the credit side. Increase in an asset, I got the money, asset increases, cash is on debit side, while liabilities also increases, and increase in a liability is on credit side. That's it. Let's do another illustration, another example for this, then we will move to the third element of accounting, which is going to be the capital. Let's suppose borrow 250,000 from bank. Now not writing the bank, I am not writing bank, I am writing from Mr. Mudassir. Okay, Mr. Mudassir, mashallah, very rich man. We borrow from him $250,000. Oof, $250,000, very big amount, mashallah. So just think, my friends, just think what is coming in and what is going out. Sir, we are borrowing, so simple, money comes in, fulus, money is coming in. So money comes in, money means asset, and asset is increasing, and increase in an asset is always on debit side. Khalas, finish. On the other hand, what is that? Sir, wallahi, we have to pay back to Mudassir. It's his right to get the money, and it's our obligation to pay him back, because we took a loan, we borrow from him. Yani, the liability is increasing, and we just said it and we just learned it as well, that liability increases on credit side. So we can write here payable, we can write here loan, we can write here name of the guy. Yani we can write payable to Mr. Mudassir, which is an increase in liability, that's why it's on the credit side. Till now we discussed two elements of accounting. Number one was the asset, and number two is an liability. Asset increases on debit side, decreases on credit side, while the liability increases on credit side and decreases on debit side. Those are two elements of accounting. The third one, which is the last one for this video, and then we will move on in the next video, inshallah. The third element of accounting is capital. Capital. What is a capital? Very easy, very simple. There is someone called entrepreneur. Entrepreneur is a person who invested money into the business. In easy English, it's an owner of the business. Owner's investment. If owner is investing money into the business, it's called capital. Investment by owner into the business is known as capital. Okay, we are going to be accountants, inshallah, after completing our ACCA, and we will be the accountants of the company, accountants for the business. We are not going to be the accountants of a owner. We will not be the accountants of individual person. We are going to be recording the transactions of business, not the owner. So in accounting, owner is a separate person, business is a separate entity, and we are going to be the accountants, and we are going to record the transactions in the books of accounts of the business, not for the owner. So khalli walli owner, ignore the owner, don't think about the owner, think about the business. Clear your direction. You are going to think about the business itself. Don't think what is happening with owner. Now, just assume capital is an investment into business by owner. So sir, tell us it increases on which side and decreases on which side. So it's same like liabilities, my friends. Capital increases on credit, same like liability, while it decreases on debit side. When the capital is going to increase? When owner invested into business. If owner is going to invest money into business, it's an increase in owner's investment. In other words, it's an increase in capital, which is always on credit side. While if owner withdraw from business for personal use. Yani if owner brings the money, it's an increase in capital. If owner takes the money, it's a decrease in capital. So capital is nothing but it's a owner's account. It's a owner's account. If owner put money into business, we are going to say increase in capital. If owner withdraws the money from the business, we are going to say it's a decrease, it's a withdrawal by the owner. And like liabilities, capital is going to increase on credit side and is going to decrease on debit side. Now, example, illustration. Let's say Mr. Javed invested $250,000 into business. Wow. Mr. Javed want to start a business. He is starting up a business and he invested $250,000 into the business. Don't think about Javed. Ignore Javed. Khalli walli Javed. Don't think about Javed, that what is happening with Javed. Ignore him. You are going to think only for the business. Just think about your business where you are working, what is coming in and what is going out. Debit, credit. Let me write the format first. Okay. Now, from the business perspective, what is coming in and what is going out, let's see like this way. Mr. Javed is the owner. He is investing money. We are not talking about Javed. We are business. So business is getting money or no? Is the business is getting this money from Mr. Javed or no? Yes, sir. Javed is giving. Khalli walli Javed. Business is getting this money. The money comes into the business from the owner of the business, mashallah. So the money comes in. Money comes in, asset increases, which is on debit side. Who is giving this money? Who is giving this money? Sir Javed. Who is Javed? Javed is the owner. Okay. Owner is investing. Yes, owner is investing. Investment by owner is on which side? Credit side. So we will write capital, which is an increase in capital on the credit side. Always remember, this entry is going to be same. Whenever the owner invested into the business, money, if he is investing cash, so cash is an asset, asset increases because business is getting cash, business is getting an asset, asset increases. Who is bringing this money? We didn't borrow, so it's not a liability. Who bring this money? Mr. Javed. Why? Because he is investor. Investor is owner. If owner is bringing the money, it's a capital and capital increases on credit side. So in our today's video, we just discussed the basics of accounting: assets, liabilities and capital. You guys must redo all the questions, and inshallah in our next video we are going to discuss the two remaining elements of accounting, which will be revenues and expenses. So till then, see you and Allah Hafiz.